Hello everybody, this is Robert from Hot Biotech Stocks, and today I'm going to introduce you to biotech companies and talk about a few specific facts about how biotech stocks are evaluated, traded, and the pitfalls. So if you are trading biotech stocks or if you want to trade biotech stocks, keep watching. So let's get started. First of all, I want to say that this is not supposed to be a full lesson about stock market. So if you don't have any trading experience, please read a few books before you risk your capital. Many of my friends know that I trade stocks and they always tell me, Robert, can you teach us? I have to use an example of a realtor. If I saw a realtor who is really successful, I can just ask the guy to teach me how to do real estate. And I have to educate myself, go to courses and stuff like that. So if you're interested in investing your money in the stock market, please educate yourself. But basically, stock market is like any other asset that is traded, like homes or real estate. It's all about demand and supply and speculation about the future value. And it is all usually a fight every day in the stock market about the bulls and the bears. And if, for example, if you're bullish about the stock and you think it's going to go up, but there are more bears out there that think the stock is worth less, they're going to beat you. And you always have to assume that the market is right. So don't fight the market. As you know, biotech stocks have the highest beta, which means they fluctuate a lot and they have the highest volatility. They are very volatile. This means you have to be able to get in and out quickly if necessary. And if you don't have the nerve or the patience, don't trade biotech stocks. And I use an example. If Amazon is down 3% or 4% during a trading day, it's a huge news. But 3-4% for a small biotech stock is just a blimp. It's nothing. So have patience and have the nerve. And again, don't even though you think a biotech stock has the best drug, please don't invest. Don't put all your eggs in one basket. Please diversify. I would not recommend to invest more than 50% of your capital in any of the stocks. If you have a lot of capital, say $500,000, I would not invest more than 10% in any stocks. So please diversify. So let's talk about the type of companies. If you ask me, I will say there are 3 types of biotech companies. Number 1 are companies in the clinical stage. These are companies that have no marketed products and they don't have any product sales. All they do is they're developing their first product. And basically, they're burning money every day. It's called cash burn. And the only way for them to raise funds and get funds is to do secondary offering, which I'm going to explain in my next slides. Or if they have a really good product, they can do a co-development with the big pharma and get money up front and they share the cost. And these companies, as you can figure, have the highest risk reward because if they have a successful drug, the stock will skyrocket. In the contrary, if the study fails, the stock will plummet. So watch out for these companies. So what is secondary offering? Basically, this is the most common way for companies in developmental stage to raise funds. It's like Federal Reserve printing new money. These companies can just issue new stocks and sell it to investors and get money for that. So IPO is the initial public offering and the secondary offering is what happens after the IPO. And when a company increases the number of stocks, of course, it dilutes the value of the stock and the stock usually goes down because the company value goes down. And I'm going to explain that in the next slide. For example, if the company has 10 million outstanding shares and every share is worth $4, the company is worth $40 million. But if the company decides to issue 1 million new shares and the company is still worth $40 million, that means the stock price has to be $3.6. And I've did the math of $3.6 per stock times 11 million, which is the number of new shares, the company value will be 40 million again. So by issuing new shares, they're diluting the stock value by 9%. But usually, when companies issue new stocks, they put it on a discount because they want to attract investors. And the discount could be anywhere from 10 to 20%. So the discount value on top of the dilution of the stock price, you see a big plunge of the stock price, which is usually between 10 to 40%, depends how it goes. But again, secondary offering is a thing that every development company does. The investors know that, because the companies need money to continue with the drug development. So usually the stock plunge is temporarily, and as they get the money and they continue with the development and they produce new clinical data, the stock price goes up. So it's nothing to panic about. But if you can avoid them and get out after the secondary offering and get in after the secondary offering, you can make a big profit. The second type of companies are the companies who actually have launched the first product, but they're still losing money until the product sales pick up. And the success of these companies depends when they can get cash positive, meaning when the profit from the sales of the first product cover the cost. So even though they have a new product and even though they've launched it, they are still losing money. And the way for them to raise funds is, again, do secondary offering or take out a loan. And I'm going to use a few examples here to just illustrate what happens if the launch goes really bad. And this is a company called Eaglet. They have a new compound and they decided to launch themselves. They got the free approval and everything, and look, this is a 1-year chart. The stock went from $5 to 78 cents. So if the launch goes bad, even though they have a approved product, you can see like 80% plunge in the stock price. And another good example is Synergy Pharmaceuticals, and this company have an awesome product. Actually, it's a really good product, and because of that, they decided to not use collaboration or co-marketing with big pharma, and they've decided to launch the product themselves. And look, stock went from $6 to $2 because they really did a poor job with launching the product, and they're suffering for that. So these stock plunges, again, doesn't happen with all the companies that have new product. This happens usually with the company that they decide to launch the product themselves, and then the big pharmas are out there, and they have there are wolves out there, and they have an army of sales forces, and they can fight you. So they can fight these small companies. So I'd rather see a small company do a co-promotion or collaboration with the big pharma after the product is approved. Then you're on the safe side. At least you don't see these plunges that we've seen in these examples that I showed you. And the third type of company, these are like companies that are cash positive. These are big pharmas like Pfizer's and Johnson & Johnson's. And they have sales, and these are evaluated based on the sales of the compound and also the pipeline, and of course the potential of their pipeline. One thing that is a threat to this big pharma are generic. If they have a compound, it is like billions of dollars sales per year, and if the patent goes out and a generic comes in, that can actually make a big dent in this big pharma's financials. Another one are really safety issues, and a good example is Vioxx. It was a $7 billion compound until they had some heart issues and they have to withdraw it from the market, so they lost $7 billion sales per year. So even though there are big pharmas, there's still risk involved, so don't be overconfident. And one thing that I have to emphasize, that this may be a little less known fact in drug development and biotech, is the probability of success for any compound. I mean, look at here, the success from a positive phase 1 study, and I'm actually going to put a link here about drug development. You can, that's another video. I'm going to make educational video about drug development. You can click here or go to my blog. I'm going to put the link to my blog here to learn about what phase 1, phase 2 is and phase 4 is. So phase 1 is a small study, and the success rate from phase 1 to phase 2 is 63%. And look at here. If even the company has positive phase 1 or phase 2 data, the chance of success for the phase 3, which is the pivotal study, is only 30%. So it's a 70% chance of failure, which is huge. And even though they have a successful phase 3 study, until they decide to submit a BLA or NDA to FDA, it's just 60%. And the chance of any BLA approval is 85%. So a positive phase 1 study only has 10% chance of getting to the market. So we are talking about 90% failure for the compounds that have positive animal studies and positive phase 1 studies. Please remember this in mind. And also, this is one of the reasons the drugs are expensive, because big pharma are losing billions of dollars in the research and development because there is 90% risk for failure. So please keep this in mind. In the last 2 slides, I'm going to talk about risks and pitfalls. There are a lot of analysts out there to give recommendation for a stock price. I would not follow the analysts blindly. But if there, you have to look how many analysts are following a company. If you have 10 analysts and 7 of them are positive and 3 of them are negative, it's good to have a good analyst support, so that's good. But if a company has only 2-3 analysts and they are giving like outrageous price targets, take those with a grain of salt. Don't follow them blindly, because you never know the analyst's aim or intent of the price target. Maybe they're trying to hurt the company or trying to help the company. So always be cautious. And there are big pitfalls with the biotech stocks. Again, cash position, how much money they have, do your homework, and I'm going to do videos about how to evaluate biotech companies' cash position, avoiding risk of secondary offering. Negative clinical studies, of course, is a very bad news for small companies. It usually plunges the stock. And even the competition, for example, if there are 2 companies competing for a breast cancer drug, and the competition has a positive study result, that would impact your company's stock, because the competition increases and they might take market share. So it's always the competition's drugs also you have to follow. And again, as I showed in my previous slide, even though you submit to FDA, it does not guarantee approval. So FDA rejection is also a big blow to the stock, and that's something you want to avoid. I would get out of the stock if it's closest to FDA approval date, just to avoid these risks. And the last slide, I'm going to talk about what drives biotech stocks up is anticipation. Basically, how they anticipate if they announce an investor meeting or conference presentation, and they're going to present the clinical study results. The stock usually 3-4 weeks before that meeting starts to go up. Again, if the company says they're going to report the study results in the second quarter of 2018, we can figure out the stock will start moving up in April in anticipation. Same thing in anticipation of NDA approval. If they're expecting NDA to get approved, and the stock starts to move up weeks before the NDA approval date. And one thing to note here is that NDA submission is basically not a big catalyst, because they're expecting companies to submit NDAs. The approval is a key factor. So NDA approval is a key factor, not the NDA submission. And merger and acquisition. If the company have a really good pipeline, and there are some investors who get into the company with the hope that the big pharma will come and pay a big premium to get to buy the company, basically. Let me see if I have any other slide after that. Yeah. And one last slide is how the biotech companies are evaluated, how the stock prices are set. And this all depends on probability of success of the clinical studies. As I showed you the slide with the probability of success. If they have a few phase 2 studies that are positive, of course, that increases the chance of a phase 3 study. And the probability of obtaining FDA approval, the good analysts know what FDA expects companies to provide to get the product approved. So if you have a good NDA package, the increases the probability of success for FDA approval. And that's also taken into consideration. How many years is left until the compound will hit the peak price? And that's something I have to talk about more. For example, if a company has a compound that are anticipated to make $500 million, but they are just in a phase 2. So until they go to phase 3, until they submit the NDA, until the NDA is approved, and it takes a few years to sales to pick up, it might take 6 years. So it's going to take 6 years for that company to hit, or maybe 6, 7, 8, 10 years, peak sales. So that company is evaluated, if it's 2018, the peak sales will be in 2026. So companies evaluated based on 2026 peak sales, and they have a formula how to backtrack and set a price in 2018 in anticipation of 2026 peak sales. Market penetration is another key factor. There's always competition, and how much the new drug can get piece of the pie. That's also something that the investors look into, and that's if they can get 10% market penetration or 40% market penetration, that's a major factor. And also pricing of a drug. I mean, how successful they are to bump up the price, or even if the price drug too much, actually that might hurt the sales. If it's too low, they don't have the margins, so the pricing of the drug also a key factor in evaluating biotech company stocks. This is my last slide, and hopefully you enjoyed it. Please consider to subscribe, because I'm gonna have in this YouTube channel, I'm gonna do more educational videos, and also I'm gonna have 2-3 videos per week, talk about what's hot, what hot biotech stocks are for that week. I'm gonna give you when to get in, what price to get at. I'm gonna tell you the company, the risk and the benefits and everything. So please consider to subscribe, and also please consider maybe to go to my blog and subscribe to emails, because I can shoot an email about the quick swing trades for biotech stocks. Hopefully, I hope you enjoyed this presentation, and you can consider to subscribe. Thank you, and happy trading.